Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video I'm going to talk about one of the trades that I did on a covered call strategy, and I took a small loss of $83.98. I did the math, and so here's the trade right here. It would have been back on the 13th of September. So right here I bought 200 shares of steel at $13.32 a share. Total cost $26.70.95. And up here I sold two calls at 57 cents a piece. That's $57. Strike price $13. Expiring on the 20th, so that would have been a weekly. And so I sold two of them, so I took in $112.47. And then on the following Monday, I immediately got out, and I'll explain in a minute why I did that. So here I sold the 200 shares that I just bought for $12.87, and got back $25.66.98. So paid $26.70.95, got back $25.66.98. That's a loss of $103.97. Now on the calls, I sold them for $112.47, bought them back for $92.48. That's a profit of $19.99. And so when you do the math and you add it all up, my total loss is a net loss of $83.98. Now the question is, why did I do that? Why don't I just hold the shares and sell cover calls month after month, like what so many people like to preach? Like the cover call is an income strategy. And my first point is that right there. The cover call strategy is not an income strategy. Now, if we look at the options and the strike price on the calls, okay? And right now, steel is all the way down to $10.63. And actually, let me start out by saying the reason why I got out is because of this right here and because of this right here. This right here, this was on the 14th of September. Some airstrikes happened on Saudi Arabia. And also, to boot, 48,000 workers of General Motors went on strike. So when I saw all that, I didn't even want to wait to see what was going to happen to steel. I knew that there was going to be some major volatility in the waters. And I was pretty sure, even though I don't know for guarantee, I was pretty sure that steel was going to go down. And it turned out I was right. I put little arrows here where I bought and sold steel. So this blue arrow, that's on the 13th, is where I bought. That's $13.32, and that's where I got out. And since then, steel has gone all the way down. Actually, I need to go out further. That's a zoomed up model. So I need to go all the way out further here. So this is a 3-month chart. There's my little arrows right there. And I had that zoomed in earlier, and so steel has since gone all the way down, and it's trending down now. Lower highs and lower lows. So it's been trending down ever since then. So obviously I made the right choice, didn't I? Now, what a lot of people might say is, why not just hold the stock and continue to sell these calls month after month? And here's the reason why I don't believe that the cover call strategy is an income strategy. Now, if we go back to my transactions here, I sold $13 strike price calls, and I got $57 for a weekly call. Okay, that's $57 a week. That's pretty good, right? But if we look at those same $13 strike price, and now let's say we go out a month, 29 days. Let's take a look. $13 calls. This is 29 days. I'm getting, the bid is $11, the ask $13. I'm only getting $12 a month. So is that your idea of an income, to buy steel at $13.32 and watch it goes down to $10.63 and then make $12 a month? How long is it going to take for you to recoup your loss in your shares, making $12 a month? I'm down, what, $300 a share? $13.32, $2.50 a share. If I'm making $12 a month, what's that, like 10 years? it's going to take a while. So, and if we go out even further, let's say we go out 64 days, it takes me 2 months to make the $57 that I made in a week if I would have held it, but I didn't want to hold it. Okay, and that leads to my second point, that when you sell a covered call, or you use the covered call strategy in your investing, you need to set a stop loss. Now, how do you determine what price to get out, when to get out, is completely up to you. I use every tool in my book. I don't just go by the charts. I don't just go by, well, it broke below support, it's dropping. No, I go by anything and everything that I can. And if I buy a stock and I see some crazy news come out on the stock that I just bought, or in the world in general, then I'm probably going to get out. And you hear it over and over, you shouldn't trade the news, but I do. And look how much money it saved me, because I keep up, and it only takes 5 to 10 minutes a day to read the news. I'm not going to read every detail of these articles. I mean, this is Wikipedia. I can't even believe it, but they now put a lot of these news stories in Wikipedia. You can go on Wikipedia and read all about the strike of General Motors here and everything in Wikipedia. And you could do the same thing with the oil strikes. Here it is right here. You can go in Wikipedia and you can read all this, or you can read any news. But me, I just take the 1 minute that it says, aha, there's an oil strike, General Motors is going on strike, so I'm going to get out. I use other things too, okay? If everything in the world was going really wonderful, but then I see steel were to do some crazy nonsense like this, even though there's good news in the world, I might also get out. The point is, you got to have a stop loss, because the covered call strategy is a risky strategy if you don't have a stop loss. The stop loss protects you. Now, the other thing you could do is you could buy put options, but then that's an option caller strategy, and that's one of my favorite strategies. I like it. But the covered call strategy is just you buy the stock and then you sell some calls. And the way I look at it, when I sell calls, selling a call option is like putting in a limit order to sell the stock. Selling a put option is like putting in a limit order to buy the stock. Why is that? Because, well, when you sell a call option is a contract to buy the stock. But you're not buying the call, you are selling the call to somebody else. That means somebody else has the right to buy 100 shares of that stock from you. And if they choose to do that, then you need to have 100 shares of that stock, and you are going to sell it to them. So every time you sell a call, you are putting in a limit order to sell the stock at whatever strike price is of that stock. So when I sell covered calls, I don't do it to try to make income. I don't think of the word income. That word does not come to my mind. The word that comes to my mind is profit. I am trying to lock in gains on shares, the 100 or 200 or however many 200 shares of the stock that I buy. I'm trying to lock in gains on the stock that I believe is a good stock, and I'm not always right, but I believe it's a good stock. That's why I'm buying the shares. And when I sell the call, I am putting in a limit order to sell the stock at the strike price of that call, and I get paid money to do that. So if steel would have traded and stayed above $13 a share and I would have held on to it, then my dollar cost average was $13.32. Let's double check. Where's it at? Yep, $13.32. I took in 57 cents. So if by the expiration, which would have been September the 20th, if on September the 20th, steel would have traded above $13 a share, and let's say it stayed at $13.32, then this contract would go down to 32 cents. That means it would have gone down $25, and so I would have made a $50 profit on my $1,300 investment. So actually $2,600 investment, because I had 200 shares. And that would have been a pretty reasonable return in only 1 week, 7 days. That would have been about a 0.09, almost a 1% weekly return. Okay, so the covered call strategy can be a very profitable strategy if you correctly trade it. But if things go wrong, then you need to have your stop loss. And I think that's the main point that I will end this video on. You can trade covered calls safely if you have a stop loss. But if you don't have a stop loss and you think you're just going to hold on to this stock and year after year or month after month you're going to sell to open these covered calls, then it only takes one big mistake to wake you up. Like, imagine if you would have bought steel, let's say a year ago. Let me get out of the zoom mode here. Let's say you would have bought steel a year ago when it was like up here or something, or even down to here at $18 a share, and now it's all the way down to $10 a share. Would you want to be selling covered calls on this stock that you paid $18 a share for, and now it's down to $10 a share, and you think you're going to make what, 20 or 30 bucks a month, or even $50 a month, or even $100 a month? I mean, are you willing to wait 28 months to finally break even? And that's your idea of an income strategy, right? So I say the covered call strategy is not an income strategy. It is a trading strategy. More specifically, it is an options strategy, or an option trading strategy. So when you sell covered calls, you magically metamorph from an investor, or whatever investor you want to call yourself, into an option trader. And that's a good thing, because I like trading options. I do it all the time. I don't always make videos on everything that I do, but if you look at my transactions, this is everything that I've done since September the 5th to the 16th. And I'm not always making videos on everything I'm doing, but if I can think of a way to explain why I do what I do, I take great pleasure and enjoyment out of doing what I'm doing and sharing whatever experience or knowledge that I have about options and just investing in general with the world of cyberspace. So thank you for watching this video. I hope you got some good stuff out of this. Set your stop losses and you're okay trading covered calls. But if you don't have a stop loss, then in my opinion, at some point you could head into some trouble. It only takes one mistake. So I will see you in the next video. Any questions or comments, feel free to ask, and have a good day. Ciao.